Good afternoon, everyone, and thank you for joining us today on this beautiful weather day in New York City. My name is Henry Schilling. I'm a member of FIASI's board of directors, and on behalf of FIASI and the entire board, I'm very pleased to introduce this afternoon's event featuring the ESG in Fixed Income Research Competition Award winners. I'm going to be serving as MC this afternoon. This afternoon's event will kick off with opening remarks by Dr. Donna Rapacchioli, Dean of the Fordham University Gabelli School of Business and competition, along with FIASI at DBRS Morningstar. Then we'll move on to the ESG in Fixed Income Research Competition Award winners for the presentation of their research paper. Each presentation will be introduced by a moderator and run for about 25 minutes. We may, I should warn you up front, run maybe as many as 5 minutes over time. But I don't think more than that. Each presentation will be introduced by a moderator, and as I said, will run for 25 minutes. We've allocated a few minutes following each presentation for questions and answers. So please submit your questions via the question window on the screen in front of you. Just one housekeeping note, and that is that there may be members of the press in attendance, and we encourage members of the press to quote any of the speakers in today's event, but we ask that you reach out to the speakers and verify these quotes before they're actually published. With that, it's my distinct pleasure to introduce Dr. Donna Rapacchioli. We have been fortunate to partner with Fordham on the first annual ESG in Fixed Income competition, and to have the dedicated support from Donna and her team at the Gabelli School of Business, in particular, Dr. Srish Chatterjee and Dr. Eun-Hee, who you will meet shortly, as well as Dr. John Finnerty, who couldn't join us today. Dr. Rapacchioli's area of interest and research include earnings management and international accounting. It is in connection with her interest and research in international accounting in particular that it's fitting, I believe, to have her kick off the event that features 3 papers focused on the common theme of ESG disclosures. This was, I hasten to add, by coincidence. A case can be made, at least in my view, that ESG investing has become the new normal. At the same time, there are still no universally adopted standards for how companies can measure and report on their relevant and material sustainability performance factors. Therefore, it seems to me that there is a potentially important role to be undertaken by the international accounting community through its standard setting body to advance the development of standards in this area. Perhaps there is something that Dr. Rapacchioli and her colleagues at the Gabelli School of Business can help contribute to. At least that's just a thought. So with that, I'd like to turn the platform over to Donna.
Thank you, Henry. It's such an exciting time for ESG research, as Henry was mentioning, as well as credit research and fixed income. I want to say that I'm very proud of the longstanding relationship that we have with FIASI. And this student competition really is a new chapter that brings together our institutions in areas that we greatly value. And the first is around ESG, and the second is around credit analysis. We really take pride in our ESG curriculum, and to Henry's point, At the Gabelli School, we have a sustainable reporting concentration that students can take. And we are partnering with the Sustainable Accounting Standards Board. And many of our students are doing research in these areas to try and develop standards that can be applied and be used so that we can really assess the ESG metrics that companies are reporting. But our relationship with FIASI is long-standing. And, Henry mentioned Professor John Finnerty. I want to cite him as well, who was a winner of the FIASI Hall of Fame. And I remember fondly attending that event. In addition, our other faculty, many other faculty are doing research in both credit and ESG. So I see great synergies here. One other thing that I will share is that I'm proud that this year we received funding to launch the O'Shea Center for Credit Analysis, which is another space where I think FIASI and the Gabelli School can really partner. One of the things that makes me very proud about today's event is that it brought our students into the limelight. And for those of you who know me, you know how important student and faculty research is to me. So I am super excited to hear the presentations. And I do really want to thank Professor Allman and Professor Chatterjee and Henry for putting this all together into something that I hope is an annual event. So with that said, and my sincere gratitude, I turn it back to Henry. Thank you.
Thank you so much, Donna. Let me now invite Larry to make a few introductory remarks on behalf of FIASI. And Larry, I will turn the screen over to you.
Thanks, Henry. And thank you too, Donna. We really do appreciate, I'm president of FIASI right now and on the board. I've been a board member for about 7 or 8 years. But we've enjoyed the relationship with Fordham for a few years now. You mentioned John Finnerty, Donna. He's been a instrumental part of FIASI for a long time now. And we're excited to continue, building that relationship with Fordham and the Gabelli School of Business. So thank you for this. And we really enjoyed the research competition as well, and the ESG conference that we hosted together back in April. And I too am looking forward to the presentations today. I do want to take this chance though to thank our own Henry Schilling. He's our resident expert at FIASI in ESG, and he has done an incredible job, I think, in working with Fordham, but also just with FIASI and all the sponsors, and pulling together panel discussions, and also working on this research competition. We really appreciate you, Henry, and thank you for your time and effort, and look forward to continue leading in ESG. But in addition to ESG, FIASI does a lot more. As many of you know, we've been active with other events. As a matter of fact, this week we hosted a conference on autos and credit ratings. We had a great panel discussion led by Ralph DeCesar. Next week, we're doing a panel discussion on CLOs, which is a very hot topic in the marketplace. And then on Wednesday of next week, we have our annual meeting where we're going to have our officers are going to be changing. We're going to be installing new officers next week. This is my last meeting as president. So I'm looking forward to Monica Agarwal, who is going to be my successor next week. We hope you guys can join us for those events and for other events that we're going to be hosting later this summer. And Henry, I'm going to turn it back to you to kind of kick off the presentations.
Larry, thank you for the kind remarks. Very much appreciated. Thank you. I'd like to now introduce Dr. Eun-Hee, who will serve as our first moderator. And by the way, because our program is so packed with presenters and information, we're going to dispense with introducing the moderators and their backgrounds and experiences, but their biographical sketches are on the FIASI website, so I encourage you to take a look at that when you have a moment. So with that, Dr. Eun, it's over to you.
Thank you, Henry. I'm very pleased to moderate this first session of the presentations. And in our first session, the presenters are the 2 undergraduate students from Gabani School of Business. They actually graduated this spring from Gabani. And the winning paper is their honor thesis advised by Professor Chidambaram. And the title of the paper is The Impact of ESG Scores on Bond Yields and Bond Characteristics. The presenters are Xavier and Resham Sansi. Junior and Resham, you're going to have 25 minutes for this session. And you can present for 15 to 20 minutes, and we can have 5 to 10 minutes for the Q&A sessions. And for everybody else, the participants, if you have any questions, please type in your questions in the Q&A box, and I will, read all your questions of the presentation and for the presenters to answer. And if the advisor, Professor Chidi, wants to jump in to answer, please also feel free to do so. Now, without further ado, let me pass the podium, actually the screen, to Junior and Resham.
Thank you. I will be sharing my screen now, and Julia will be starting us off.
Yes, thank you so much for the introduction. Good afternoon. My name is Julia Xavier, and today, along with my co-author, Resham Sansi, we'll be presenting our paper. Many thanks to our advisor, Professor Chidambaram, and also the many other professors who provided data and feedback on our work. The notions of both corporate social responsibility and environmental, social, and governance activities relate to how firms incorporate social and environmental concerns and how they conduct themselves. These dimensions have been growing considerably in importance across all industries from multiple perspectives, including that of consumers and particularly investors. Socially responsible investing strategies have grown to more than $30 trillion as of 2018 and are estimated to reach $50 trillion over the next 2 decades. The growth and emphasis on impact investing mirrors the general trend of investors focusing more on a firm's social impact, incorporating measures of this performance in their due diligence process. This linkage between ESG performance and firm risk and financial performance is particularly important in the fixed income market, which we have focused on in this study, as this asset class has been underrepresented in research regarding the impact of ESG on the sector, despite making up a higher percentage of firm financings as of 2019. Still, there are several contentious issues when it comes to understanding the link between ESG performance scores and financial performance and risk. The relationship between bond characteristics such as bond yields and covenant intensity and a company's ESG scores has thus far been inconclusively described, with past research yielding mixed results and focusing mostly on pre-2010 data. The existence of a variety of different performance scores such as the KLD scores, Asset4, and corporate registry scores further complicates this issue, as these measures provide alternative ways to interpret a firm's social impact and can thus offer competing perspectives of the relationship between ESG performance and a bond's characteristics. As such, our purpose in this research was twofold. We first seek to understand the relationship between bond characteristics and these individual ESG performance scores. We also hope to compare the nature of these relationships in order to make a meaningful assessment of how these performance scores relate to one another and their relative use in the bond due diligence process. Our paper attempts to move the literature forward by filling in some gaps left by previous research. While we validate the findings of these studies in terms of examining offering yields, differing from these, we shift the focus to credit ratings and bond covenants in an effort to analyze a separate and material factor that can influence bond yields while also focusing on more recent data. Finding a correlation between ESG and credit risk can help provide a clearer picture of a firm's credit risk by factoring in the presence and/or absence of how they incorporate ESG into their firm. While there has been an increasing interest in ESG criteria in the investment process, it is still not uniformly figured into the creditworthiness evaluation and lending practices employed by banks and other lenders, allowing this avenue of study to potentially offer an as of yet unincorporated informational advantage. I'll now hand it over to Resham to discuss our literature review and methodology.
Thank you, Julia. There were multiple theories that had a bearing on our study, the first being stakeholder and shareholder theory. Past literature has described these two main lenses through which to interpret firms' actions, especially in regards to trends in ESG activities and the rationale behind implementing ESG initiatives. The idea of shareholder theory, popularized by Milton Friedman, explains that maximizing shareholder value is the way of being socially responsible in a free economy. It defines that the main goal of a corporation is to maximize shareholder value and run with maximum profitability in mind, and that environmental aspects such as reducing pollution should not exceed what is compulsory according to regulations. This has been a theory and strategy for most companies used in the past. On the other hand, the newer school of thought, stakeholder theory, argues value maximization is tied to corporate responsibility and that firms should meet with the interest of society as a whole and not only the shareholders. This theory, as described by Edward Freeman, divides a firm's stakeholders into two categories, primary and secondary stakeholders, as we can see in the infographic on the right. And it argues that both groups are essential, and while secondary stakeholders are less important in terms of a firm's survival, they still play a very important role in firms' decisions. The true value of a company is created through cooperation between both sets of stakeholders. These two theories are oppositional in the context of ESG. In the view of shareholder theory, the possible reduction in profits from spending on ESG performance could be a detriment to shareholders' interest and also harm a firm's debt-paying ability, thus increasing financial risk and cost of capital. In the lens of stakeholder theory, however, stocks of firms engaged in activities deemed contrary to social responsibility, such as tobacco, alcohol, gaming, have been shown to experience a higher cost of capital, and firms have shown to have experienced positive impacts on various aspects on their cost of capital on the basis of good ESG performance. The cost of equity of firms also has been shown to be negatively associated with ESG sustainability performance in numerous studies that we researched. Another theory that played an important role in our paper was the agency cost theory, and this is prevalent within previous literature as well, as it explains the agent-principal relationship in a firm. The agents can therefore be seen as senior executives, while the principals are the stakeholders. There's a significant agency problem that affects both the shareholders and creditors of a firm, in that managers, either in self-interest or incompetence, can take decisions against the objective of firm value maximization. In this case, it is argued that managers will engage in showing ESG practices in the firm for their own personal interests without providing real results, because monitoring such behavior is not very easy for shareholders. And as we can see, these theories play an important role in emphasizing the need for more research on this topic, as previous studies have determined that while companies focusing on utilizing stakeholder theory, it is often symbolic in nature, and this provides additional reasons why integrating CSR research could have an effect on a firm's credit rating and cost of debt. Truly integrating CSR into a firm's operations is highly complex and needs both competence and trustworthiness. Thus, as it says in our Okinomo literature review, limiting the potential hazards arising from agency risk and lowering the firm's cost of debt and equity. In previous studies that have begun to examine this effect of ESG integration on the cost of public debt for a company, there have been ambiguous and inconclusive results. One major study we looked at was Li et al., which applied their hypothesis to the Chinese capital market, covering the overall financial status of the issuer to multiple aspects of ESG governance. Li et al. Found that corporations with worse ESG performance separately all had higher financial leverage, poorer financial profitability, smaller or even negative growth within shrinking industries, and were more prone to financial distress that may lead to bankruptcy or default. This study reflects a similar hypothesis to this very paper, as we aim to look at multiple factors within ESG scores that can help identify a firm's overall risk in the fixed income markets. However, the US capital markets, firms, corporate governance, regulations are all very largely from Chinese or European capital markets, and therefore we can provide a different lens into these findings. In studies done of American companies, the impact of CSR on corporate public debt seems promising. The study I mentioned before, Okinomo, finds support for communities where a firm operates, avoidance of human resource conflicts, and higher levels of product quality and safety reduce the cost of corporate debt by reducing the risk premium that such firms face. Similarly, Gay et Louis find that firms with better CSR performance are able to issue bonds at a lower cost, and that both CSR strengths and concerns are considered by bondholders. However, within the same study, they also identify that CSR performance cannot significantly be associated with bond maturity. So even though these researchers theorized that increasing ESG awareness would create a stronger bond between the two, patterns over time present an inconclusive picture. In terms of our current research, we focused on the angle of individual relationships between bond characteristics and ESG scores, as we felt it was important to establish this relationship first. We retrieved data from two major sources, our bond issue data from Mergent Fixed Income Securities Database, FIASD, and our ESG data from the Risk Metrics KLD database. The FIASD database gives detailed data on bond issues in the US and details on bond characteristics. The KLD database provides data on ESG scores for corporations along several dimensions in the forms of strength and concern scores. The strength scores are higher when indicating positive performance, and concern scores are higher when denoting negative social performance. We also constructed a total performance score, which equals the firm's strength score minus the concern score. We merged these two data sets based on company characteristics we obtained from CompuStat, and we retrieved data on both the strength and concern scores for each bond issuer. We were able to achieve complete data on 4,778 bond issues over the period from 1997 to 2018. And throughout our data period, we saw the number of bond issues, the total amount of funds raised, and the mean size and median size of the issue increase, as we can see in these graphs presented here. The first two dependent variables in our analysis are offering yield and offering yield spread. These variables represent the cost of capital for firms and directly impact the profitability of the issuing firm. The next two dependent variables are the credit rating on the bond issue and the number of covenants on the bond issue. We found that the mean credit rating was 9.25, which translates to a BBB rating on the bonds. The main independent variable of interest are the three ESG scores, performance, strength, and concern, which we were able to measure for each bond issuer using the KLD ratings. Our first measure was the strength score, which is the sum of the individual KLD strength scores in each of the 7 qualitative business areas. And similarly, the second measure of concern was also the sum of the individual KLD concern scores in each of the 7 qualitative business areas. Our third measure, performance, was the difference between the strength and concern score for each bond issuer year. We use multiple lag firm characteristics as controls for our regressions, such as controls for size, firm value, and profitability. We also used a dummy variable, which indicated whether the bond is privately placed bond, and another dummy variable to indicate whether the bond was a shelf-registered bond. We controlled separately for these characteristics, as the yield on the bond and the bond terms could be privately negotiated between the issuer and the bond investor, or systematically reflect the ability of the firm's manager to choose the timing of a bond and obtain favorable terms. So we controlled for these in terms of that bias. And in our analysis, we ran an ordinary least squares regression line to examine the relationship between the ESG and bond characteristics. We examined the significance of the coefficients on the CSR scores to check whether our hypothesis held and that a firm's CSR score could affect the cost of capital and terms of the bond issue. Now I will hand it over to Julia to present our empirical findings.
Thanks, Resham. As shown in this table, we utilized 4 models in analyzing our data. Model 1 shows the results when we use only KLD strength and KLD concern scores as explanatory variables. Model 2 shows the results when we augment the regression in Model 1 with control variables for both firm and bond level characteristics. Model 3 shows the results when we use only KLD performance as the explanatory variable. And Model 4 shows the results when we factor in control variables to Model 3's analysis. In analyzing whether KLD ratings affect bond yields, we find that, as expected, the bond yields were negatively correlated with the total CSR performance score and strength scores, and positively correlated with CSR concern score. In terms of the other control variables, consistent with our predictions, yields were correlated negatively with return on assets and maturity, and positively with leverage. Similar results were observed in regards to measuring the effects of KLD readings on yield spreads. In Model 1, we find that there is a statistically significant negative correlation between the firm's strength score and its offer spread, and a positive and significant relationship between its concern score and its offer spread, when strength and concern scores are the only explanatory variable. The relationship becomes less significant in Model 2 with the inclusion of control variables in the case of the correlation with total strength score. Models 3 and 4 in the table demonstrate that, consistent with prior research, a firm's total performance has a statistically significant negative correlation with its offer spread, both with and without the inclusion of firm and bond level control variables. This indicates that favorable ESG performance appears to be linked with favorable spreads for issuing firms. In terms of the relationship between ESG scores and credit ratings, surprisingly, there is a statistically significant negative correlation between both the total strength score and credit ratings and the total concern score and credit ratings, indicating that lower ratings in either area would result in credit ratings indicative of higher risk. However, when we're including all control variables in Model 2, we see that the relationship to total concern scores becomes statistically significant and positive, which is more in line with expectations. The firm performance score was negatively correlated with credit ratings and statistically significant as well in both Model 3 and Model 4, which would imply that better ESG performance is associated with credit ratings that demonstrate lower firm risk. This table represents our results regarding the link between KLD scores and covenant intensity. Model 1 shows that there is a statistically significant positive relationship between the total strength score and the number of covenants, and a negative relationship between the total concern score and the number of covenants. While this is surprising, one possible interpretation lies in the fact that green bonds may have covenants dealing with their ESG practices included in their covenant count. These relationships hold true in Model 2 with the inclusion of firm and bond level control variables. In Model 3 and Model 4, it is shown that there is a statistically significant negative relationship between a firm's overall CSR performance and its covenants, with and without the inclusion of explanatory variables, which seems more in line with expectations. Our findings overall thus suggest that firms with better KLD profiles benefit by lowering their cost of capital and having better credit ratings. That issuers with higher CSR scores tend to have more covenants on their bond issuances is an avenue we believe merits further exploration, as these results could have a number of implications. We conclude that there's value in analyzing firms from an ESG perspective when it comes to evaluating their fixed income offerings, and that investors could benefit from incentivizing firms to improve their social impact, as they may reap benefits when it comes to obtaining financing.
We hope to extend our base study by examining the impact of alternate CSR scores, such as the Asset 4 scores and ratings from the corporate registry. Due to contributions of several professors, we have recently acquired corporate registry and Asset 4 data, which we hope to use to extend the analysis, firstly by reestablishing the individual relationships between bond characteristics and these scores, but also examining the relationship between each of the ESG data sets and their relative usefulness in the due diligence process, and that comparison. Preliminary results of our Asset 4 data analysis is promising, with significant correlations being found between positive ESG performance and lowering issuing yields. Thank you for listening to our presentation today, and we would be happy to answer any questions.
Thank you, Junia and Resham, for the great presentation. Very strong results, very interesting results. Here, we have several questions. Let me just run through one by one. Okay. The first question is that, is there any time variance on the ESG effect? For example, is it possible that effect is more significant in the recent years, such as after the 2008 financial crisis, compared to the earlier years? Either one of you can take the question, or we both can answer the same question.
I can take this one. I definitely think that time plays a major role in these results, as we've seen the importance and emphasis of corporations focusing on ESG throughout the years, especially after the 2008 crisis. That kind of was almost a turning point where it became more important, or just in general, external values became more important to a firm rather than simply looking at the internal, like we mentioned before, stakeholder versus shareholder theory. That I feel like kind of helped switch more to stakeholder theory after the financial crisis. And we've seen, like we mentioned before, throughout our data set, we've seen all the bond issuance increase, and the firm, like sorry, sorry. But just to explain what I'm saying a little bit more, we've seen the trend rapidly increase after 2008 as well. And we've also seen kind of outside of our presentation and our thesis, but the introduction of green bonds and the green bond market also increased as well. Although that necessarily doesn't have to do with our thesis, I think that kind of just shows the importance of ESG really increasing after 2008.
Julia, you want to add anything? Or?
No, I think she covered it perfectly.
Okay, great. Thank you very much for the answer. Yeah, I totally agree with you. You know, there should be a stronger ESG effect of the financial crisis, especially when there's more awareness among our investors and our communities on the ESG and on the CSR. You know, thank you for the answer. Now, the second question, I look at the question, it could be a little bit tough for you, but let me just bring this question out. You know, the question is that the firms with a lot of financial resources will have lower yields and higher ratings. They will also have more capacity to engage in ESG and CSR. Now, could that be possible that your results on the relation between ESG score and yields are driven by this possibility?
I can start, but Resham, feel free to hop in, or also I'm sure our advisor probably has some thoughts on this as well. I think this is something that we tried to factor into our analysis. When looking at some of the control variables, we did attempt to control for issuer size, as well as the number of assets. Those are both control variables we tried to factor in, bearing in mind that the level of firm resources would have some impact on their ability to engage in ESG and would have some bearing on that relationship. And so it is something that we thought about and tried to incorporate, though I'm not sure, obviously it's not a perfectly controlled in any sense, but we did try to factor that in. And I think there's always the possibility that some dimension of that is impacting the results that we had.
Resham, you have anything to add?
Yeah, I think as Julia mentioned, we did try to control for that. And also it's not necessary that firms that do have more financial resources do engage in ESG more, although they do have the capacity to do so. So I think in that sense, that's another aspect that could be researched further, but we did try to control for that in our regressions.
Great. Now let me look at the question. You know, there's another question. Let me read the question here. Okay, so you have 4 regression models for each hypothesis. The R-square is much higher when company and the bond characteristics are added to the ESG variables, where we include more controls, and R-squares is much higher. Can you comment and explain the possible reasons here?
Sorry, could you repeat that question? I'm not exactly sure which model you're asking.
Yeah, I think for all your hypotheses, I mean, the question says that for each hypothesis you have, right? You have different hypotheses. You run the different specifications, different regressions, and the R-square is much higher when company and the bond characteristics are added as a control variable to the ESG variables. But can you comment and explain the possible reasons? So typically, we know that when you include more and more control variables, R-square will become higher. So in this case, I guess the question is that, is there any other channel possible, like the relation of the bond characteristics and the ESG variables? They could interact with each other, could also, causing the R-square to be higher. And if that's the case, would that affect your results?
I'm not sure if this fully might answer that, but I think something we didn't control for was industry, and I think industry also plays a huge role on ESG performance as well as financial performance. So I think that might be one avenue that we didn't quite look at in terms of how that affects the ESG performance and bond characteristics, since we didn't control for industry. But I'm not 100% sure if that answers the question, if that's one possible way that they could relate.
Junior, anything to add?
No, I don't think.
No, I think, it's a fair, to say nobody can control for everything, right? So it's, therefore, I do think you have a very strong results for the relation between the ESG score and also the yields and ratings. Just look at all your key statistics, and they're just so highly significant, right? So therefore, for that sense, even if you add more controls, the company and the bond characteristics, given such a high significance of your coefficients, it's unlikely, your ESG fact or ESG variables will lose the significance because any additional controls. So that's just my feeling. But anyways, I think we run out of time. And thank you again, very much for your presentation, and very excellent presentation. And also congratulations on winning the competition. Thank you. Thank you very much. So next, let me pass everything back to Henry. And Henry will introduce the second session, the moderator.
Thank you, An, and thank you, Julia, and thank you, Resham, and congratulations to both of you. I should reiterate, if we hadn't made it clear, that each of the winning papers can be accessed on FIASI's website. So it's there now, and we encourage you to review it and also to follow up with any additional questions that you might have. I'm making a leap, but I believe that the authors would be willing to entertain those after today's session. So with that, I would like to introduce Dr. Srish Chatterjee. He's no stranger to FIASI, and I'm going to turn Srish the screen over to you.
Thank you, Henry. Thank you very much. Our second paper is about the effect of ESG disclosure on investment efficiency. It's going to be presented by the two authors, Elsa Allman and Frank Vaughan. Both of them are PhD students at the Zicklin School of Business at Baruch College. Elsa is in her 5th year in the program, and Frank is in the 3rd year of the program. They have an excellent paper, very nice paper. I will not take too much time now. I will not stand in between their presentation and the audience. I will just request all the people to write your question in the Q&A box at the bottom of the Zoom screen. And then at the end, I will try to select as many questions as possible. So with that, I would invite Frank to start your presentation.
Thank you, Srish. Let me share my screen. Okay. Great. Good afternoon, everyone. I'm Frank, and I'm a 3rd-year PhD student, as Srish mentioned, in Baruch College. First, I would like to use this opportunity to thank FIASI and Fordham University for this great venue to present our work. This paper is a joint work with my colleague Elsa and is titled "The Effect of ESG Disclosure on Corporate Investment Efficiency." In the past few years, there has been a growing demand for ESG-related information. For instance, institutional investors with 500 trillion asset under management or more petitioned the SEC to mandate sustainability disclosure in October 2018. And in May 2020, the SEC subcommittee recommends mandating ESG disclosure. However, the United States have not yet adopted a clear mandate or a regulation mandating firms to disclose their ESG-related information. So under these circumstances, one of the natural questions to ask is, what is the benefit if ESG information quality and quantity increases at the firm level? So we start off from this natural question that we have. And in the literature, studies suggest that ESG reporting will have similar effects as financial reporting would. So for instance, in a study by Christensen and his co-author in 2019, they state in principle, mandatory ESG reporting will have similar effects as the financial disclosures would do. And to recap, the benefits of increased financial disclosure quality included a variety of tangible capital market benefits, such as improved liquidity, lower cost of capital, higher asset prices, and etc. But in particular, related to our study papers such as Biddle and Hillary in 2006 or Doe et al. In 2019, they report increased financial information quality leads to investment efficiency through mitigating the problem of information asymmetry. Now, of course, we can't expect ESG-related information to have the same exact effect as the financial information would, due to the fact that these two information are distinct from each other. So I wrote down here 2 bullet points to highlight some of the differences, the main differences. One is that, as the previous presenters talked about, ESG information is more catered towards a wider range of stakeholders instead of focusing on shareholders. And furthermore, ESG information is not yet standardized. Thus, ex ante, it is uncertain how much and how well firms will supply new information. Nevertheless, the recent research suggests ESG-related information may have impact on corporate level decisions. So as I highlighted some of the works here, studies find ESG information does affect firm value, equity market reaction, and also firm values. But if you noticed, the previous studies focused more on macro level questions. How is the stock market reaction? How will the valuations be affected by ESG related information? And the studies have covered less or focused less on how corporate policies will change in reaction to increased ESG related information. And this leads to our research question, which is, does increase in quality of ESG disclosure information improve investment efficiency? To answer this question, we apply the difference in difference approach to mitigate potential confounding factors. Our research is focused on the US firms. The exogenous shock that we adopt while using our difference in difference approach is a regulatory shock originating from the EU. So I will discuss in the next couple of slides on the details of what the regulatory shock is. But this shock allows us to identify the increase in the quality and quantity of ESG related information to allow us to connect it with how firms change or alter their corporate investment policy. To give you an overview of our results indicate the following. First, we verify that the directive in the European Union countries do impact the firms in the US exposed to this directive. And second, we find that those firms for those firms, investment efficiency improves after the directive. And furthermore, we find that such firms increase their debt issuance and experience a reduction of bond yield spreads at issuance. Now, given these findings, the potential explanations could be either that there indeed, like financial information, there was a reduction of information asymmetry, in particular for the debt markets, and it's a possible explanation. But another explanation could be that these firms are exploiting the situation. Basically, they're window dressing. So they're releasing these information in order to brand themselves as green firms or sustainable firms. But as I will show you in our further cross-sectional studies, that that our results lean more towards the first story and not the second one. Right, so the research design is that is our quasi-natural experiment, the directive. It is a regulatory shock, and the directive, or the NFRD, requires public, to be precise, public interest entities with 500 employees or more to disclose ESG-related information. This 500 employee or more threshold actually allows us to split the sample into treated groups and control groups. So our treated group would be the firms that are, of course, based in the US, but have a subsidiary in the European Union countries with 500 employees or more. And the control groups are those US firms that are based in the US that does not satisfy those categories. So even though they have 500 employees or more, if they do not operate in the European Union countries, they may be categorized as control groups. Now, I use the word, I said it may be because we conduct different robustness checks by assigning different different groups of firms into different control groups to make sure that our results are robust. And I would like to also highlight that our assignment of the treated group is also used in other studies. I may have skipped that slide, but if it comes up, I'll mention the paper. Right. Now, before we move on to our regression analysis, I would like to kind of give you an idea of what's happening by providing some anecdotal evidences. So Guest and Philip Morris are both US-based firms which have a subsidiary in the European Union as well. However, Chevron and Costco do not have a subsidiary in the European Union. So as you can see you can see my cursor. So as you can see, after the 2014, when the directive was enforced, you see Costco, Guess actually increasing their ESG-related information drastically, and also for Philip Morris, of course, they have been improving over time, but they increased their rate of releasing ESG-related information. In contrast, Costco and Chevron have been disclosing their information, but their reports were more standalone, and also they report it in a consistent manner without any change before or after the directive. And also for Costco, very similar, and Costco does not publish any ESG related reports. Right, so our sample consists of 1,240 US firms between 2012 and 2013. This horizon was chosen because the directive is in 2014, and the data we used are the following. And here it is. So our treatment group is consisted of 162 firms exposed to the directive with 500 employees or more operating in the European Union. And this assignment is actually borrowed from a paper by Grewal and her co-authors in 2019. which was published in Management Science, if I remember correctly. And the control groups are the 1,078 firms not exposed to the directive, but as I mentioned before, for robustness checks, we change the definition of the treatment and also the control group into, so we have three definitions of treatment groups, and also for control groups, we have 3 of them to check our robustness. Right, so before we move on and to address our research question, we validate that the shock indeed affected, okay, oh, I saw a Q&A, it just popped out, but so continuing, so to validate whether the shock was relevant to the firms based in the United States, we do a DID analysis on ESG disclosure, and we indeed see that for the treatment groups, after the directive, they increase their ESG disclosure. Basically, this table is just so the graphical representation of this table is actually this, right? So they're showing that the treatment groups are increasing their disclosure scores, whereas the control groups are not. So we are validating that indeed the regulation had an impact on the firms in the United States. Now moving on, this is our main table, which we show how firms change their investment policies after the directive. Before I interpret the coefficients, in the literature on investments, papers show that firms with low cash and high leverage are prone to underinvestment, whereas firms with high cash and low leverage are more prone to overinvestment. So what they would do is they would invest more than they can. And on the other hand, for the firms with low cash and high leverage, they would underinvest. They wouldn't be able to invest as much as they could or should. This is mainly due to the fact that there is information asymmetry between investors and management, and due to agency problems and moral hazard problems, there could be various reasons why firms may underinvest or overinvest. So keeping that in mind, what we find is that firms which are more likely to underinvest are increasing their investment. So whereas we do not find that effect, of course, the coefficient is negative over here, but statistically insignificant. So, but nevertheless, what we claim is that this is improving the investment decisions of the firm. And what we do in our future specifications is that we summarize it into a more compact definition. We adopt a variable called overfirm from financial disclosure literature, which basically is the same thing that I just did in the previous table. So this overfirm variable has a low value if the firm is prone to underinvestment problems, and this overfirm variable has a high value if it is subject to overinvestment problems. So if you take a look at this first column, what this is showing you is actually the same result as the previous table. So this treatment after variable are the firms that are subject to underinvestment problems who are increasing their investment. And this coefficient over here are the firms which are likely to overinvest. Of course, the coefficient is negative and statistically significant over here. But when we test the joint significance, it is not jointly not equal to 0. So that what we claim is that ESG related information is solving problems for the firms which are prone to underinvestment. Now, of course, if they're investing more, then they should be able to source external capital. And what we find is that indeed, these firms that are prone to underinvestment problems source additional debt from the credit market. So in the equity market, there is no effect in the bid-ask spread or the new equity. So what we're thinking is that because ESG related information is more related to sustainability of the firm and downside risk of the firm. That is why we are seeing more effects from the debt market. Now, keeping that in mind, we actually also test what happens for the newly issued bonds. So why we go into the bond space is that for bonds, we can actually see different maturities of bonds. And if you take a look at this table, of course, we capture a lot of effects from all of the bonds, but the effects are more pronounced, actually statistically significant only for the bonds that have longer maturities. And this leads us to think that indeed this is related to the characteristic of the ESG related information, which explains the firm's sustainability or the downside risk of the firm. Right. Now I will talk about some cross-sectional results. Since our finding is closely tied to information asymmetry, we split the sample based on the KZ index, which is a proxy of financial constraint, and we find a higher magnitude for the firms which are financially constrained, and also for using the CEO ownership as a proxy for manager entrenchment. What we find is that firms which are likely to have entrenched managers are the ones that are benefiting from the quality ESG information disclosure. And to investigate further related to the corporate governance aspect, what we find, so we use different proxies for corporate governance. For instance, whether the firm has an independent board or not. And in this case, if you have no independent board, the firm would be considered to have a lower corporate governance quality. And that is where we find that the firms are increasing their investment. And using the same proxy, what we find is that for those firms that had lower corporate governance quality, they are indeed sourcing new additional debt from the credit market. So this leads us to conclude more like that the ESG related information is indeed reducing information asymmetry between the firm and the outside investors. Right. And we do have other interesting results related to how for instance, if you had a low ESG information before the directive, then those are the firms which improve more compared to the ones that already had high ESG related information released before the directive. And similarly, in this table, if the change was above the median, these are the firms that are benefiting the most. So if you increase more information than related to ESG, those are the firms that are benefiting the most. Right, so these are different tables that show robustness tests, which I will pass. You can take a look at our paper, or if you have any questions, you can email me or ask me anytime. So to conclude our paper, the firm exposed to the EU directive increased the quantity and quality of ESG disclosure after 2014. We verified that the NFRD had an effect on US firms, and those exposed firms reduced underinvestment and are able to raise new debt. And these are pronounced, especially for firms with ex-ante lower ESG disclosure levels, financially constrained, and with more entrenched managers, which leads us to think that ESG-related information resolved the problem, alleviates or at least mitigates the information asymmetry problems of firms. Right. Thank you so much. And I look forward to the questions or any comments you have.
Thank you, Frank. That was a very nice presentation, and absolutely right on time.
Thank you.
We do have a few questions. Let me start with a question about the information asymmetry that you mentioned. And in one of your tables, you were showing how the effect is on the equity market side, both for new equity issue as well as the bid-ask spread.
Mhm.
Now, can you help us understand, why that is the case? The question is why the equity market is not impacted by this information asymmetry resolution, and why is it more pronounced in the debt market? So, what is missing here?
Right. So we thought about it, and what we think is that, so for financial disclosure, it's people find that financial information affects bid-ask spread, and also in certain cases the equity issuance as well. But since financial disclosures are more catered towards shareholders, equity shareholders, that is why you capture these effects from the equity market. However, the ESG related information is catered towards stakeholders, and also perhaps the longer horizon questions, like, is the firm more sustainable? Will the firm go default eventually? So the story that, the content of the information is more related to what the debt holders or debt investors are interested in. So that's why we move on and compare results for the short maturity bonds and the long maturity bonds. And the results from all the bonds are actually coming from the longer maturity bonds. So what we're assuming, what we're thinking now is that, okay, ESG related information must have a longer horizon, more related to sustainability than, well, of course, equity. I'm not saying equity holders are less interested in the sustainability aspect, but debt holders could be more interested in that.
Yes, but that we see people. I see Henry coming up. Henry, are we on time, or do we have?
I think we can wrap up with the commentary that you are about to make on this question, but I think we're going to have to move on.
All right, let me move on to another question, and I'll try to combine a couple of questions that seem to me to be similar, and that is about the, and you see improvement in investment efficiency, higher investment being made by some. Is it possible to see whether investments are directly related to the disclosure, the ESG disclosure, force the firm to spend certain kind of money and certain kind of investment?
Oh, I think I lost connection, or maybe Swiss lost connection. I'm not sure.
Yeah, this is a question. Maybe my connection is not stable. I'm not sure which end. But if you can hear me, the question is just about the overall nature of investment, over-investment, non-investment, and for your particular sample of firms, whether or not the investment is directly related to the ESG disclosure. Is it possible that the firms that are being asked to make this disclosure will have to undertake certain kind of investment to be able to make a minimum cut of their ESG disclosure?
I see. Okay, I see. So, right, I understand the question. So the question is that basically, is the shock interrelated with investment decisions? So it's not purely exogenous. So in order to meet those standards, perhaps firms may have to undertake certain investments. Is that the question?
Yes, that was the nature of the question. But
right.
yes.
So unfortunately, we don't have a clear answer for that. But what we are so our story is that since it originated from the European Union countries, from the US firm's perspective, they should take it as an exogenous shock. They can't anticipate this. So we feel like it satisfies the category of an exogenous shock. But right, we will think more on that and actually get back to you if we have a better answer for that.
All right, I'll ask whether there are still a couple of questions from the audience that I'm not able to ask because of time pressure, but is it possible for us to share those questions to the authors?
Sure.
So they'll
Sure.
be able to respond to them. Okay. Okay.
Sure.
Thank you very much.
Yeah, that would be great.
Yeah. Thank you very much.
So thank you so much, Srish. Thank you, Frank, and congratulations to you and to Elsa on winning the competition award. And we appreciate the presentation. And with that, what I'd like to do is turn to Greg Lemo-Stein. Greg, in addition to being a member of the FIASI Board of Directors, is also a managing director and head of analytics and research at S&P Global. So Greg, I'm going to turn this over to you.
Thank you very, very much, Henry. It's an honor to be here and to be introducing our third winning research paper. I'd also like to say congratulations to the winners of the earlier two awards. Really impressive work and interesting presentations, very relevant to my day job at S&P. And the same is true of our third paper, so we'd like to get right to it. The authors are Mingying Cheng and Dr. Eun-Hee Kim, and the title of their paper is Strategic Environmental Disclosure and Financial Materiality, Evidence from U.S. Firms on Nasdaq and the NYSE. Mingying Cheng is a graduate student at Fordham, and Dr. Kim is a CSR and Sustainability Research Initiatives Fellow at the Gabelli School of Business at Fordham. And so I will pass it over to, I guess, Mingying Cheng first. Will that be you to start?
Yes.
Thank you very much. Go right ahead.
Okay. Yeah, thank you, Greg, for the wonderful introduction. Hi, everyone. My name is Mingying Cheng. I'm a third-year PhD student from Gabelli Business School. First of all, I would like to thank FIASI and the competition committee for recognizing our paper and give me this opportunity to present it. The paper is titled Strategic Environmental Disclosure and Financial Materiality, co-authored with Professor Eun-Hee Kim. Earlier this year, US officially returned to the Paris Climate Agreement, and President Biden signs order on climate change and set goal to meet net zero by 2050. See, so climate change draws a lot of attention. Corporations as a key players in society are expected to take actions and to be more environmental friendly and also disclose on their environmental activities. Speaking of environment, many people treat it as one concept. In fact, there are a wide range of environmental issues involved, from greenhouse gas emission, waste management, to energy efficiency and biodiversity. So you see, there are all kinds of dimensions for firms to disclose and also for external stakeholders to evaluate on those information. But let's take a step back and think about the question. Should we actually value the same information for all firms across different industries equally? Let's say if we look at the disclosure on energy efficiency and compare two firms, one is from beverage industry, another one is from mining industry. So clearly the disclosure on energy efficiency contains more value relevant information or more important information for firm in mining industry, right? With that being said, we use a financial materiality concept issued by SASB, which stands for Sustainability Accounting Standard. They identify the material issues for different industries from the perspective of investors. Basically, they parse out which issue matter more for each industry. As I showed here, the dark cell indicate the material issues, whereas the light one indicate immature issues. So in this paper, we're trying to study whether and how firms disclose financial material information specific for the poor environmental performers. As I mentioned earlier, firms face increasing pressure to behave environmentally responsible and to disclose on their environmental initiatives. In fact, environmental outperformers are rewarded. They are associated with higher market value, better stakeholder relationships, and lower cost of capital. Whereas for those with environmental concern will suffer from decrease in stock price, regulatory cost, and damaged reputation. So for poor environmental performers, given their environmental misconduct, they tend to protect themselves from further scrutiny by withholding material information. Therefore, our first hypothesis is that firms with poor environmental performance decrease the proportion of financial material information. A corollary to our hypothesis one is that poor environmental performers will increase the proportion of financial immaterial disclosure given the total level of environmental disclosure. Then we further look into the disclosure within the financial immaterial issues and identify two different types. One is environmental salient issue, another one is general information, which is a disclosure that does not reveal specific environmental outcomes. I will explain those later later in detail. But before I dive into our hypothesis 2 and 3, I would like to give you a big picture about of our framework. Basically, firms' total environmental disclosure consists of two categories. One is financially material, another one is financially immaterial. And within financial immaterial disclosure, there are environmental salient issues and environmental general issues. As I mentioned earlier, SASB defined financial materiality from the investor's perspectives, meaning they identify the important issues for investors. However, as we all know, firms actually face various stakeholders, and their interests can be different from investors. Just because the information is financially immaterial does not necessarily imply it is not important to other stakeholders, such as environmental NGOs and customers. They will react negatively to environmental concerns, even the information is financially immaterial, meaning other stakeholders keep their eyes on environmental salient issues. Therefore, our second hypothesis is that for poor environmental performers, they would decrease the proportion of financial immaterial but salient issues to avoid backlash from external stakeholders. However, at the same time, firms want to look good. Also, as our previous presenter mentioned that firms want to brand themselves as a green firm, they want to present themselves as environmental friendly and seek for institutional conformity, even with their environmental misconduct. To do so, firm will talk about some general information like, oh, we have environmental management system. We adopt certain environmental certificate, and we have sustainability board committee, which will improve our environmental performance in the future. We see those information shows their commitment to environment, but we cannot evaluate the outcomes. Therefore, our conjecture is that to manage the tension between transparency and institutional conformity, poor environmental performers will increase disclosure on general information. To test our hypothesis, we create a novel data set by mapping firms' environmental disclosure into financial materiality framework. We collect the environmental disclosure from Thomson Reuters ESG database, previously called Asset4 database. Our sample consists of around 1,500 US firms from 2002 to 2016. We measure the proportion of different types of disclosure for each firm year, given the level of total disclosure. We use the environmental score for from Thomson Reuters to evaluate environmental performance. And so the raw value range from 0 to 100. And to specifically measure the poor performance, we subtract the raw value from 100 and scaled by 100. So higher value meaning worse performed. For our model specification, we regress different types of disclosure on poor environmental performance, on poor environmental score. To avoid reverse causality, we use a 1-year lag independent variable. We also control for the firm characteristics such as firm size, profitability, and state level pressure like environmental NGOs and state regulatory pressure. Also, we include industry and year fixed effects to account for unobservable variables. So what we find? We observe that firms with weak environmental score tend to reduce the proportion of material disclosure, which also means they will increase the proportion of immaterial disclosure. As for the information within the financial immaterial category, poor environmental performers will decrease the proportion of environmental salient disclosure, but increase the general disclosure. In terms of the change in magnitude, with 1 standard deviation increase in poor environmental performance, meaning they performed worse. Material disclosure goes down by around 2%, and environmental salient disclosure goes down by 0.2%. And general disclosure goes up by around 0.4%. Our results are robust with other tests. I will just briefly mention them. We address self-selection concern by matching the low environmental performers with high environmental performers. And it's possible that corporate governance would drive the quality of disclosure. So we control for corporate governance with different proxy. For example, the corporate governance score from Thomson Reuters, analyst coverage, institutional ownership, and audit quality. Also, we use alternative measure from KLD to measure the poor environmental performance. Lastly, to address reverse causality concern, we use a dynamic panel model by including the lag dependent variable on the right-hand side. So in this paper, we find that firms with weak environmental record decrease financially material disclosure to protect themselves from potential financial scrutiny, and at the same time increase general information to seek for institutional legitimacy. Our findings contribute to corporate sustainability and impression management literature by proposing a new decoupling mechanism through the financial materiality lens. I would like to wrap up my presentation with a quote from Shakespeare: "All that glitters is not gold." In particular, for poor environmental performers, greater disclosure does not necessarily imply greater transparency from the financial materiality perspective. That's all of my presentation. I'm happy to take any questions.
Well, thank you very much. Very, very interesting. As I said, very, very relevant to what we do. It's a hot topic. I wouldn't even say that it's greenwashing, it's maybe green managing, how companies are managing the amount of their disclosures. A few questions have already come in, and I would encourage anybody else who's on the call to use the Q&A box. do have some time. One question I'm curious about is that obviously disclosures, financially material or otherwise, can be seen by both shareholders and other stakeholders. Why would a firm with very good environmental performance manage or have less disclosures that are maybe financially immaterial but environmentally salient? Or is it just the fact that the poor environmental performers are just adding so much more? Are the good performers scaling back on environmentally salient topics?
Yeah, I think in our analysis, we focus on the poor environmental performers. So they would decrease the salient issues. So relatively to environmental outperformers, they will disclose less salient issues. So environmental outperformers disclose more on the salient disclosure.
Okay, so it's not that the good ones are necessarily holding back. It's just that the others are feel an obligation to add more material to the market, so they add the immaterial, financially immaterial stuff.
To look as transparent as the good performers.
Yep. Another question I'm very curious about, and this may be a tough one because it's really more of your hunch rather than maybe the data, but it seems like that your hypothesis, which is shown in the data, is that there is a relationship that environmental disclosure has a relationship to firm environmental performance, either in the quantity or the nature of it. So this is a strategy. So the poor environmental performers are disclosing more financially immaterial, but environmental salient or general environmental information. Is this, the market should be able to learn this pattern over time? Yeah. Do you think if the market learns this disclosure will remain valid for firms?
I think that's definitely a good point. And yeah, both, so we thought about this learning path from the market, since this financial materiality concept is quite new to the market. Yeah, it's definitely our next step to look for the time trend.
That'll be very interesting.
Yeah.
Thank you. Any other questions from the audience on this paper? Maybe other panelists, or Henry, do you want to chip in, or should we move ahead?
I think we're actually right on time, Greg. Okay. So my suggestion is that unless there are any other questions, that we wrap up.
Okay, fantastic. Excellent presentation. Thank you very much.
Thank you.
So thank you, Greg, and thank you, Mingying, and congratulations on the paper. It raises a number of very interesting issues and questions that I think will invite further exploration. So with that, I want to thank again everyone for participating this afternoon. We're right on time. In case we didn't make it clear, each winning team is receiving a monetary prize of $2,000. And also, I should mention that details regarding the second annual competition will be announced by early September. So stay tuned for that, but feel free in the meantime to get in touch with us in the event that you have any questions, and you can direct those questions to Laura Nauser, our executive director, at nauser@fiasi.com. I also want to encourage you to join us for 2 upcoming meetings in June. Larry mentioned those at the outset. The first one is on June 22nd on the topic of CLOs. And our annual meeting, which is scheduled to take place on June 23rd, is an annual event during which new officers are identified and voted upon at that time or earlier through proxies. So thanks again. Stay healthy, and we hope to see you soon. Bye-bye.